Hello, welcome to our Excel lesson for Chapter 10. I'm eager to show you some of these transactions, and yet I want you to know that I tried to select a problem here that is fairly straightforward, combining some different skills, some different analytical skills for which we could use Excel. So as we look at the Excel problem, it is ATC 10-10. It's on page 589, and it says Mastering Excel, Spreadsheet Analysis. Wise Company was started on January 1 when it issued 20-year, 10%, $200,000 face value bonds at a price of 90. Interest is payable annually at December 31st of each year. Wise immediately purchased land with the proceeds from the bond issued. Wise leased the land for $27,000 cash per year. The lease revenue payments were due every December 31st. Set up the following horizontal statement model on a blank spreadsheet. The statement of cash flow activity column is for the classification operating, financing, or investing activities. So on December 31st, enter the effects of 2013 transactions. Assume that both the interest and lease payments occurred December 31st. Notice that the entry for the lease has already been entered. As an example, calculate the ending balances. And then B says enter the effects for 2014, C says for 2015, and D says for 2016. And then immediately in 16, immediately after the sale of the land, they repurchased the bonds at 93. So now if you are just watching this and you have not read the chapter, you have not become familiar with the terms, you haven't listened to the YouTube presentation on the chapter overview, you haven't watched the introductory problem, this will be less meaningful to you because you won't have a clear understanding of the terms we're using. You may not have a clear understanding of the analysis we're doing even if you know the terms. But I just want you to consider going back and doing that preparation work before you start doing this work. Now, if you actually are looking at the spreadsheet the way it is set up for you, you'll notice that this top part is that I've just highlighted here is set up. It has only the first two lines is set up. Let me do that again. There we go. That's the better way to do it. There we go. So you'll notice it has the date, the statement of cash flows, the cash, the land, the bonds, the bond discounts, retained earning effects, and then your name. So before we go any farther, I really want to make sure that you get your name up here in this student name box, because you have to understand all of these look very much alike when I'm looking at them, and unless that student name is there, I don't even know what student I'm working with to make grading comments or even to begin to find the grade. So it's very helpful if you would put your name on it for me, please. Now then the rest of your sheet is blank, so then we begin to ask, well, how do we find out about these transactions? So we have the dates over here for the transactions. We have some information for the transaction. We're always going to start with column A. So the first thing we want to do is look here at ATC 10. We want to look at these transactions. The first transaction there is going to be the sale of the bonds on January 1. The second transaction is going to be the purchase of the land on January 1. The third transaction is going to be the lease on December 31. And the fourth transaction is going to be the payment of the interest on December 31. So we're going to need to have 2 dates for January 1 and 2 dates for December 31. So we're going to put those in. Then one at a time, we're going to work on these transactions. So we're going to look across here at these transactions, and the first one is the purchase of the sale of the bonds. So it's a financing activity. It brought in $180,000 in cash, and it set up a bonds payable of $200,000, and it gave us a $20,000 discount because it sold at 90%. So 90% of 200,000 is 180, and the difference between 180 and 200,000 is a discount of 20,000. So that's the first transaction. The second transaction is that it was an investing activity. It was $180,000 where cash went down and land went up because we invested in land. The third transaction is on December 31st. It's an operating activity because it's the rental revenue off of our lease. It's cash going up by $27,000 because somebody paid us, and rental revenue increases retained earnings by $27,000. And you can see it looks much like those early little statements that you did at the start of the class all those weeks ago. So we have the effect on net income is a plus $27,000 for lease revenue. Then at the other on December 31st is an operating activity, and it is $20,000 went out in cash to pay our interest on this $200,000 bond. And then remember that the bond is $200,000, and it's a 10% interest. So 10% of $200,000 is $20,000 that we have to pay on these bonds. We also have to amortize that discount, straight line, $20,000 and 20-year bond, so $1,000 a year. So now the retained earnings is going to go down by $21,000, and the interest expense is going to go down by $21,000. So we have the effect on net income is a reduction of net income because of interest expense. That means retained earnings is going to go down by that interest expense, and the discount is going to be amortized by that amount of money. Remember, the discount in this is always a contra. It carries a debit balance. It runs contrary to the account payable, the bonds payable. It's used to reduce the bonds payable to their cash equivalency value. So that's what we were doing up here. Now we're amortizing it. We're going to make this discount start going down to zero, and we're going to make this book value start going up towards $200,000. So at the ending of 2013, we would have cash of $700,000, just the sum of these numbers. So we just use our sum function. When I click here, you can see the sum function right there. It's telling you I'm summing those, and it's lighting up all those cash boxes. For land, it's doing the same thing, summing that land and lighting up those land boxes. Payable, bonds payable, it's doing the sum function, summing that F column, and that's what's lighting up for us. The discount on bonds, same thing. We're summing the discount on the bonds, and that area is lighting up for us. The retained earnings is summing the retained earnings in the H column. And notice that now we recognize, probably more clearly than you ever did at the beginning, that whatever changed over here in this net income had to exactly equal what changed over there in that retained earnings. That revenues minus expenses was going to be the same amount, even though they would be closed out to retained earnings, so that would all be transferred in. We don't have the sophistication here of closing entries. We're just trying to analyze what's happening to these accounts. Now then, we always have this proof. We want our total assets to equal our total liabilities. So we look at our total assets, and they are summing those two assets right there for us to see. Now total liabilities is summing, it says it's going to equal to F10, but it also should be summing here. So when we look at these claims, we have F10, F8, H8, FH, excuse me, F8, G8, and H8, and that's what's showing up right down here in these total claims. So as we look at those, that's the information that we're wanting to put into this Excel spreadsheet. The next thing it asks us to do then is to do the same analysis for 2014. So I've moved it up so you can see it. Hopefully it's above my head and you can see how it works. Now we have 2014, but we only have the December transactions. The January transactions do not repeat themselves in the next year. So enter the effects. Assume that both the interest and the lease happen on December 31st. So here we have to put in two dates, December 31st. They're both operating activities because they have to do with operating our business, earning our rental income, paying our bond expense. So this first one is an operating activity. It's $27,000, the amount of the lease. It's lease revenue, so we have cash going up, we have lease revenue going up, and we have retained earnings going up by the amount of that lease revenue. Then we have on December 31st, an operating activity. Now we're paying the interest on the bond. So we have the $20,000 interest on the bond. We have the $1,000 amortization on the discount. And so then we have $21,000 of interest expense, the sum of the two interest expense, and all that is going to go into the retained earnings. So now we have to calculate those ending values. Here we have for cash, you can see it in here. It's adding together these two cash columns, C12 and 14. Then we have the bond, excuse me, this would be the land. So we have the land transaction, it's adding that up. And then we have the sum here of all of F12, all of the F column, all of the G column, and all of the H column. And I'm lighting these up so you can see them here on the screen in the bigger, and that you'll get the color presentation. And then we get net income, and the net income is equal to the lease revenue minus the interest expense, and it's there. Now remember that the balance sheet up here, the balance sheet, those are permanent accounts. Those stay open at year end. So they always have to bring forward their beginning balances. So when we look at this beginning balance, we have that to be $7,000. It would be even better to have a cell reference that it's equal to this. So this would be nice to say equals and do a cell reference so that we get that connection, and that this one equals the cell reference, and we get that connection, and that this one equals the cell reference, and we get that connection. So you can see, begin to see how we use our cell references, and gives us continuity. If we have to go back and change anything, that will automatically change with us. But then those are the only permanent accounts up here in the balance sheet, these assets and liabilities. These accounts in the income statement are temporary accounts. They're closed out at year end, so they don't have a beginning balance. They're always zero. So then as we look at 2014, we have these ending balances. Now we have to do this proof, and this is going to be the sum of those two accounts, and this one is going to be the sum of these three accounts, and it's adding those together for us, and we're keeping this in balance. Now here's 2015, and we have the same information. This is the beginning balance. These will come forward from those prior balances. So likewise, this one should say equal to that one, and this one should say equal to that one, etc., all the way through this. I'm going to pull that back up now. And then we have only two transactions, the revenue and the expense. So here is the revenue. It's an operating activity. It's $27,000. Cash goes up by that much. Rental revenue goes up by that much. And that rental revenue will be closed out to the retained earnings. So in the balance sheet, the retained earnings goes up by that much. Here is the bond interest expense for December 31st, an operating activity. Again, it's 10% of $200,000 or $20,000 in cash that we have to send out to the bondholders. We also have to amortize the discount with $1,000, so that makes our total interest expense $21,000. And then that $21,000 of interest expense is closed out, temporary account closed out to retained earnings, so it will come to rest ultimately in the retained earnings statement. Now we have these ending balances. So here's 2015 ending, and we have this sum, which is going to add together those three entries in the C column, always using that beginning balance on these permanent accounts. And so then we have the sum of the D column, even though there's only one number in there. And again, the same thing, we have the sum of the F column, even though there's only one number. The G column, the sum of the G column, and the sum of the H column. Now, so you can see that those were in there. Now I'm hoping that you would realize that you could use your drag function. You could click on one of these and drag it across to the others, and then keep those equations without typing in all of those numbers. Go back and change this equal sign, because you'll have something else in there after you do the drag function. Now, the total assets here then, again, are the sum of the two asset accounts, and the total liabilities are the sum of the liabilities accounts. Highlighted the wrong thing. There you go, so that those will light up. Now then, the net income is going to be the sum of this J column. You're going to add those two together to get the net income. And that is the 2015 transactions analyzed to see their effect on balance sheets using Excel now. Not heavy calculations, but analysis of the distribution of effects in the balance sheet. So here's 2016. Again, we have our beginning balances in here for 2016. Now in 2016 we actually only have 2 transactions because we've sold the land, we've paid because we sold the land and we're paying back the bonds. So because we're doing that in 2016, we won't have revenue and we won't have payments. So this first one in 2016 right here, we still have those beginning balances, don't forget. Now we sold this land. This land had a historic cost. Let's come back up here. Here's our land right here at $180,000, had that historical cost. I'm going to come here, $180,000, sell the land. We sold it for $190,000. So we made a $10,000 gain on the sale of the land over here in the income statement, and that gain is going to go into retained earnings. This little blank column in here is what's indicating these are 2 different financial statements. This one's the income statement, this one's the balance sheet. And so when we're looking across that little column, that minor column there, we're closing those accounts into the retained earnings. The next transaction here then is we retired the bonds. And in this particular case, we retired the bonds and we had a loss because the bonds had a face value of $200,000, but they had a discount of $17,000, so they only had a book value of $83,000, and they had a book value of $183,000, and we sold them for $186,000, so that caused us to have a $3,000 extraordinary loss on this retirement. So it's a financing activity because we decide to sell it. It's extraordinary because we're retiring these bonds, we're redeeming them and retiring them, and so it's not a normal activity. And so we have a $3,000 loss. See, there was a $83,000 book value on these bonds, and we had to pay off $186,000, so we had to absorb that other $3,000 ourselves to get that the total for the $186,000 that we had to pay off to these folks. It's $186,000 because we down here in the last transaction they purchased the bonds at 93. So 93% of 200,000 is 186,000. They'd only had a 183,000 book value, so we had to absorb the other 3,000 to get the total amount of compensation to the holders of the bonds. So we had an extraordinary loss. Now then, the ending balances here, again, we're going to sum these, so we're going to sum all of these, but when we do that, we don't have very many accounts left. So we have cash, but when we sum, we retired this, we sold this land, so when we sell this land, when we sum that column, it's 0. We retired these bonds, so when we sum that column, it's 0. We retired these, this discount, we made it, so it's 0. And now retained earnings has $18,000 beginning balance. It has a $10,000 gain and a $3,000 loss. So the sum of those is going to be $25,000 in retained earnings. And we like that because we need our claims and our assets to equal one another. So the owner's claims and the assets in the business equal one another. And then our net income is a $10,000 gain, a $3,000 loss, but we're better off by $13,000. So when we use Excel this way, we get a chance to see how we use Excel to analyze changes in financial statement distributions between the assets, liabilities, owner's equity, revenues, and expenses, and then to see what's happening to our cash flows. I hope that you can appreciate the bit of a difference that we're doing here. Primary focus is on a restricted number of transactions just to see what happens to the financial statements, and Excel allows us to do that really in a quite straightforward way. Thank you for working on this assignment. If you have any questions, again, you're welcome to contact me, send me an email. You're welcome to come by my office, come to office hours, come to class, come to lab. The lab is on Monday at 12 o'clock in room 118. Anyone's welcome to come. See you around campus.